In 1986, a young Microsoft employee looked at a stock certificate worth $21 a share and felt absolutely nothing. It looked like a worthless piece of paper on a forgettable Tuesday morning. He was completely wrong. That same year, Microsoft offered its employees a choice: take a modest cash raise right away, or take company stock instead, in a business that barely anyone outside the tech industry had even heard of yet. This is the story of Microsoft, and of the ordinary employees who accidentally became rich, not because they were brilliant investors, but because they simply didn't sell. The stakes were bigger than anyone in that office understood. What looked like a bad trade in 1986 would turn into one of the strangest fortunes in American business. But the $21 price wasn't even the strange part of this story. What happened to that stock 9 separate times afterward is what nobody in that room saw coming. Somewhere between that decision and today, thousands of completely ordinary employees who never once touched a trading floor ended up with more money than most Wall Street bankers ever made in their careers. So how does a piece of paper nobody wanted turn into a life-changing fortune decades later? It starts on a single day in March, in a Seattle suburb. March 13, 1986. The day Microsoft stopped being a private company run out of a handful of buildings, and became something the entire stock market could own. Microsoft's initial public offering priced its shares at $21 each. By the end of the very first day of trading, the price had already climbed higher. Bill Gates was 30 years old that day. On paper, his stake in the company was suddenly worth an estimated $350 million, and within a year Forbes would name him the youngest self-made billionaire in the country. But this story isn't about Gates. It's about the hundreds of far less famous employees, secretaries, engineers, and support staff, who were offered the exact same stock. Most of them had never owned a share of anything in their lives. To them, this was just paperwork attached to a job that paid modestly at best. Microsoft wasn't yet the giant everyone instantly recognizes today. Back then it mostly made operating systems and software tools, useful products, but nowhere near a household name outside the small computer industry. So when the company offered stock instead of a bigger paycheck, plenty of employees quietly assumed it was a bad deal. Cash felt real. Stock felt like a gamble. Nobody could have blamed them. Most companies that went public around that time never became household names. Plenty quietly faded within a decade. Financial advisors at the time often told new tech employees the exact same thing: don't get greedy, cash out your stock options the moment you can, and never let paper wealth control your decisions. But a small number of employees made a different bet. They kept their shares instead of cashing out. That single choice is where this story really begins. Picture one junior employee in that Redmond office, still in his 20s. Not a founder, not an executive, just someone processing paperwork and running errands between departments every single day. His manager laid out 2 options. Option 1, a modest annual raise, paid out immediately, guaranteed. Option 2, fewer dollars now, but company stock instead. He didn't know Microsoft's future. Nobody did. Windows hadn't taken over the world yet. This was still just a scrappy software company competing against dozens of others. He chose the stock. Not because he believed in the company's future, but mostly to avoid the extra paperwork of cashing out. It was, in hindsight, one of the laziest financial decisions imaginable. And it would turn out to be one of the smartest. He tucked the certificate into a folder, then into a drawer, then more or less forgot about it entirely. Life moved on. Rent was due. Bills didn't wait.
Meanwhile, across the company, hundreds of other employees made the exact same quiet, unremarkable choice. Nobody threw a party. Nobody thought it mattered yet. Within 18 months, some of those same employees would quit for entirely unrelated reasons: family, better offers elsewhere, boredom, never imagining what they were walking away from. Our employee quit Microsoft less than 2 years after the IPO, chasing a better title elsewhere. A higher salary at a different company seemed like the obviously smarter move at the time. He kept the stock certificate, mostly out of laziness, not strategy. It followed him through 3 moves, 2 cities, and 1 divorce, buried in a box of old paperwork. For years, he didn't check the price. There was no app for that in 1988. Checking a stock price meant calling a broker or reading fine print in a newspaper. There was no real incentive to check anyway. Selling meant paperwork, a trip to an actual broker's office, and a conversation he never got around to having. So the path of least resistance simply won out, and the folder stayed exactly where it was. So the certificate just sat there. Through the early 90s. Through the launch of Windows 95. Through the entire rise of the internet. Nobody in that house thought about it. Meanwhile, Microsoft was quietly becoming one of the most valuable companies on the entire planet, its software running on nearly every desktop computer sold anywhere in the world. But none of that mattered yet to a piece of paper sitting quietly in a cardboard box, 3 decades removed from the office where it was first signed. Here's the part almost nobody understands about that certificate: the $21 price it started at wasn't actually what mattered most. What mattered was what happened 9 separate times after. Microsoft split its stock 9 times between the IPO and the early 2000s. Each split doubled the number of shares an owner held, without costing them a cent. 1 share in 1986 quietly became 2. Then 4. Then 8. Each split was barely noticed by employees who had already stopped thinking about the stock entirely. By the time the splits finally stopped, a single original share from that 1986 office had multiplied into nearly 300 shares, all traced back to one quiet decision made in Redmond. Subscribe and hit the bell so you don't miss what's next. Each split also quietly divided the original price. $21 a share slowly became worth mere cents per original unit, mathematically at least. That's the strange part of this whole story. The stock got cheaper and cheaper on paper, while the actual value of what employees owned kept climbing higher. It's a bit like a pizza getting cut into more and more slices over time. The pizza itself isn't any bigger. But if the whole pizza is suddenly worth a fortune, every single slice is too. By 1992, just 6 years after that IPO, business reporters started noticing something strange happening inside Microsoft's ranks. Ordinary employees kept showing up in stories about sudden, unexplained wealth. Reporters eventually gave the phenomenon a nickname: Microsoft Millionaires. More than 2,000 employees, receptionists, engineers, mid-level managers, had become millionaires simply by holding on to stock they were once handed almost as an afterthought. Around Seattle, some real estate agents later recalled noticing something odd in the late 80s: young, ordinary-looking buyers paying cash for houses that seemed far outside their salary range. None of them had traded a single share on Wall Street in their entire lives. None of them had studied finance in school. They simply hadn't sold their shares, and time quietly did the rest. Some quit their jobs entirely. Others just kept working, quietly aware that their bank balance no longer matched their job title at all. It became one of the strangest wealth events in American business history. Not a single lottery winner.
Thousands of ordinary employees, all made wealthy by the same decision. But our employee, the one who quit early, wasn't reading any of those business news stories at the time. He'd left the company years before the phrase Microsoft Millionaire had even been coined. As far as he was concerned, that old certificate in the storage box was just a leftover from a job he barely remembered. Life had simply moved on. Decades later, while cleaning out a cramped storage closet, a family member finally found the old folder near the bottom of a box. Inside was a stock certificate nobody in the family had ever once mentioned. She didn't recognize the company name at first glance. It looked faded, official, and slightly out of place, tucked among old photographs, holiday cards, and other paperwork nobody had touched in years. She asked her father a simple question: "What is this, and is it worth anything?" He genuinely didn't know. He hadn't thought about it in over 30 years. For a long moment, neither of them said anything at all. The father simply stared at the number on the screen, quietly trying to convince himself the broker hadn't made some kind of mistake. So they called a broker to find out for certain. What came back on the phone, after a short pause and some checking, was not the answer either of them expected to hear. Thanks to 9 stock splits and decades of relentless growth, those original shares had multiplied and compounded into a position now worth well over $1 million, all from that one folder. A raise he once turned down for a piece of paper he barely valued had quietly become worth more than every single paycheck he ever earned across his entire working career, combined. It wasn't a lottery ticket. It wasn't luck in the way people usually mean that word. It was one ordinary decision, left completely alone for 36 years. This is the strange truth sitting at the very center of the whole story. The employee never picked Microsoft because he believed in its future. He simply never got around to selling his shares. Somewhere between 1986 and today, over 2,000 ordinary Microsoft employees quietly became millionaires the exact same accidental way, not through clever trading, but by simply doing absolutely nothing at all. $21 a share, 9 stock splits, and 36 long years of simply never looking. That's the entire recipe behind one of the strangest quiet fortunes in modern business history. The hardest part of this entire story wasn't picking the winning stock at all. It was never picking it up in the first place, and then simply never letting it go for 36 years. What makes this story so uncomfortable to sit with is how little skill was actually involved. There was no secret formula, no perfect timing, no insider tip whispered in a hallway. Just a piece of paper that was allowed to sit quietly in a drawer while everything around it changed. So here's the question worth sitting with. What's sitting forgotten in your own drawer right now that you've never actually stopped to check the value of?